Hey everyone, Luca here with a new collaboration for you with Cantonese Cat and Matt. How are you guys?
Doing great.
Surviving. Survived. How are you, Luca?
Good. I was pretty shaken up, after the latest dump. Saw a lot of people, being a lot of people lost a lot in over the last couple of days, especially the ones that use leverage. And I would like us to talk about leverage and trading and how it is very similar to gambling and how not a lot of people actually make money by doing this. I would love to talk about that. But yeah, I mean, how are you guys holding up?
I mean, I did nothing except for I showered twice this weekend. I think at some point, it's just looking at these kinds of things. Just like there's once you see things stabilizing, um, and then you know that it's low liquidity weekend. Like the minimal thing you would do is to do nothing. Like if I had some extra fund, which I did have like very little, I ended up buying some, but um, I think sometimes it's just better to do nothing and just kind of reflect and and then see how it goes. It's probably a better strategy, and I think I have the luxury to be able to do nothing because I didn't use any leverage or anything like that. So I still own what I own, and it's gonna just keep doing what it wants to do. But yeah, I'm blessed, from that perspective because I did read. I usually don't check my feed. I usually just kind of carry on. I don't even really open up my DMs, but just reading, a lot of folks have kind of suffered through this, and it's not. The idea is not to say, oh, I didn't do what you guys did. Like the idea is like, yeah, no, I hear you. It's not great, and I feel for you all. Whatever it is that you guys want to do, just think more, clearly. Don't do anything, drastic. Just think through, and reassess, and to carry from there. Those are my thoughts.
Yeah, like basically, a lot of people love immediately when something happens, good or bad, they love to jump to conclusions, and especially when you're watching it live, it doesn't seem real, and I just don't think it was real. It's just something that everything seems so coordinated to me. So we got to just wait till the dust settles, and now that the dust is settling, it looks like things are stabilizing, and I think we can take a deep breath now and just go back to our regularly scheduled view of the things, because nothing technically broke, and now let's just move forward. And as long as we're not leveraged, we can move on.
I agree. I think that the most important thing right now is to avoid revenge trading because a lot of people, what they do is they lose a bunch of money and they try to make it all back, in one big leverage trade because they feel like they got nothing else to lose. So I think that's a big mistake right now. If you lost money on Friday, the first thing I would personally recommend is to avoid revenge trading and take a step back, reassess your overall situation. It's not that bad as it may seem currently. I believe that this phase precedes a very large expansion in the next couple of weeks and months. As Matt said, nothing has fundamentally changed in the markets. We're still in the same macroeconomic environment we have been in. The labor market, personal income, personal spending, the GDP growth are all resilient, while the Fed is still expected to step away from quantitative tightening and their quantitative tightening measures. So that's all bullish. The global M2 is still forming new highs. So yeah, I mean, I'm seeing everything bullish across the board, and I have here a very interesting correlation I want to make, which is between this period and what happened back in 2020. Because what we've seen, especially in the altcoin market, is something very similar to what we've seen back here in 2020. So essentially, we had this big crash that preceded, a very large expansion. And we are in a pretty similar macroeconomic environment to what we have been back then, because the Fed is now, as I've said, stepping away from their quantitative tightening measures, is expected to print new liquidity. And so there are a lot of correlations to what happened back in 2020. So, what do you guys think on this correlation?
I mean, it's very, very similar. I think it's basically history kind of playing over again with a different narrative. The the mask behind what happened was a narrative, between the economy shutting down, things like that. Whereas this time it's like, tariffs, I guess, whatever it is, the narrative is. But the bottom line is there's a lot of leverage that needed to be flushed. So I think that's kind of what we're seeing.
Yeah, agreed.
Yeah. I mean, on the midterm, I think it's pretty safe thing to say that the most important thing right now is to have some patience and let things develop because the others has lost an important high time frame support range, which has been a strong reversal point in the past. So as guys can see here, it initially acted as a strong support. Then once it was lost back in early 2025, it acted as a resistance here. Then it once again acted as a support, and now it kind of got lost once again. So I think that until this high time frame support range is recovered, the best approach right now is simply to avoid leverage and to be focused on the broader market picture. Could we have one final push lower? I think so. It is possible. Not my base case for the moment, but it is possible since the others has lost such an important support range. And so we could be, if that were to happen, if the price were to reject here, then I believe we could have a fill the wick type of scenario where we have this rejection of the prior high time frame support range, and then we partially fill this week before a continuation higher. What do you guys think on this potential scenario?
I mean, I think it's always possible to fill at least part the wick. It's such a coordinated attack that it's probably going to take a lot more, and I think a lot of people are going to take a lot more caution against that. And I think a lot of deleveraging has already happened. So there might not be any particular reason to do that. It really depends on whether or not, like you said, people revenge trade too much. If they were leveraged long to the, on the downside, if they want to do some like leverage shorts, then that way, if they actually become, positioned wrong, then fill the wick scenario may not happen. Especially if majority of folks, are still very skeptical and feel fearful. So,
Yeah, I actually have a chart that I can share to show why I don't think a complete fill of the wick is necessary here. So let me just pull that up. With the others, we can just see using the fibs from others from back in 2018. The cycle, the previous cycle, like back in 2018 down to the bottom here in 2018, we can see that prices really just went back down to the 1.272. Right, it went straight back down there, nailed it, and now it's back above the 1.414 where it has been consistently since really back in July. So I think we could get like a partial fill of the wick right down here, maybe 233 billion back down. But ultimately, it doesn't change the range at all. Like, even though it's below the bull market support band and whatever, it doesn't change the range, right? It still got rejected back in December of last year at the 1.618, just like it did for the market top back in December 2021. And it's just in that normal range. So I think perhaps, yeah, we might get another retest like a quarter of the way down or so. But I don't think we need to go back down to the 160. And I think these fibs like truly identify that the market is still healthy. It's not, nothing is broken. It's still technically okay. And also in comparison to the COVID crash too, I made a post about this yesterday, how right here was COVID, right? It hit arc resistance right here for before COVID, and then there was like a 70% crash down here. And look at that, we hit arc resistance right there, and there was like a 50% crash right there. So it's very similar to COVID, except it happened in 1 week instead of like 4 weeks. And this wick too also didn't really fill the completely that wick down there too. So we're basically kind of in a similar situation where maybe next week we could get a partial fill, just a little bit more fear before we go out. But I still stand by. Just like when this broke the arc right here, it took like a month, right? We can just zoom in to that situation right here. It took like 1, 2, 3. Yeah, it took like a month of these candles, 4 weeks to break out. And once it did, it didn't look back. And I think we're going to see something similar to that too. Once we break, and we're not going to look back. And I think it's just going to be a serious melt up and a maybe multi-year rally, maybe at least another year. and it's going to be beautiful, right? And I think you're leaning more towards that too now, Luca, aren't you? That it could be an extended super cycle.
Yeah, that's a very interesting thought. I actually shared a post on this that this latest flush actually increases the chances of a potential super cycle going forward. So my base case initially was that going forward, we're likely to see a risk-on environment that will develop over the next couple of weeks and months, aligning with a final blow-off stop in the markets. At the time, there was a considerable amount of leverage, so I think that this major deleveraging of the markets is something very positive on the long run. And I don't know, I think this increases the chances of a potential super cycle a lot. This cycle has been completely different than what it used to be. So instead of having, the normal retail FOMO cycle where the price is in a accumulation phase, and then it has that massive blow off top as retail euphoria piles in and develops, and then you're hit with the bear market like we had in all of the prior cycles. This has been a very different cycle because we had institutional adoption. So the majority of this bull market has been spent inside accumulation ranges, which is also why I think that retail interest is currently so low. The overall retail sentiment is also so low. The Bitcoin dominance is still so high. If the 4-year cycle were to be applied, then the Bitcoin dominance is very high because it would mean that we're in the late phase of the cycle, and having Bitcoin dominance over 60% is very high if we are in the late phase of the cycle. So, I mean, this is really bullish, I think. And going forward, I believe that if the labor market and personal income, personal spending, the economic growth all remain resilient, then I think, yeah, we could have a super cycle going forward and something very similar to what happened back in 2021 playing out.
Yeah, I mean, if Matt, if you want to flip over to my others chart here, just want to show the monthly Bollinger Band to show you, basically to echo what you guys have said, and just to build some additional confluence. If you just look at the technical, I'm just going to go talk about like this market structure and things like that. This basically is like a cup. This is basically a handle. The handle basically got back down to maybe anywhere from like 0.3 to 0.5 log fibs, which technically is kind of still qualify as a handle. You have a double top over here, makes you feel like, hey, once we consolidate enough, maybe we break through, because we were basically just stuck in a range over here. And then finally, we had that flush, and that flush during COVID was really what was required to really push things up a lot higher. I think we have a very, very similar structure where this is a cup. This is more or less like a very complex handle over here. And if you also look at kind of like the retracement, initially we think, hey, it hit the 0.5 tier. Maybe that was good enough, right? A lot of times when you're having the flush down with the handle back to 0.5, that's usually good. And sure enough, like we had a little bit of euphoria here back in November. We think we were just going to break out there, but nope. They decided to accumulate for longer and have a sideways move over here for like a whole year. And then finally, with this big giant flush down here, back to 0.5, which is just absolutely ridiculous to me. But it's just been stuck in a range. Like it's really been doing nothing. It's just been stuck in a range here. And this is, as far as I'm concerned, because global liquidity is going up. If you just look at the M2, it's increasing. So global liquidity is going up and things are going sideways. It really does look like this is more like a reaccumulation before things are breaking out. Going back to the Bollinger Band, a couple of things that's pretty interesting thing is here we have a squeeze here because things have gone sideways over here for close to like 20 months. When that happens, the standard deviation is just not very high, and you're just going to end up having a Bollinger Band squeeze. And in general, when you have Bollinger Band squeeze, you're going to end up having an expansion because things just don't stay sideways for that long. Usually, when you have squeeze, it really is a signal that, hey, maybe there's going to be a big move that's coming. The problem usually is it going to be a big move up or is it going to be a big move down? Right. So here you have the squeeze here. You also have the same squeeze here during COVID, and during the COVID time, we have basically a wick all the way down close to the low Bollinger Band. Here we just touched it. It's very, very similar kind of scenario here between the two. During COVID, this candle in March 2020, it didn't even reclaim the 20-month moving average. Now, the month is still early here in October, but right now it looks like we just flushed down, touched the low Bollinger Band, and it looks like the 20-month is still potentially holding here. Now, is it going to hold by the end of the month? Nobody really knows the answer to that. There could be a little bit of fill the weight kind of scenarios possible, but it doesn't have to, because the structure here in terms of my structure look very, very similar from the past. A lot of times you get this kind of like dragonfly candle where you have a big giant flush down and they don't really get filled. It's just one of those like last liquidity grab event. Here you can see the same thing happen, right? You have a V shape here, you have a flush here, and then you go higher. Here we have a little bit of V shape here, have a flush here. I think we might be getting ready for something that is gonna keep going up higher from here on. I don't necessarily think that this wick has to fill. But if it does, then man, I can't even imagine how that's going to be. All right, guys, back to you all. I think, Luca, you're talking about, oh, actually, Luca, you're talking about Bitcoin dominance. I just want to kind of show that here. Big giant wick through and trying to break back above the Ishimoku Tenkin and Kijin, the blue and red line there. And also, it basically backtests the negative sloping 20-week moving average, which if it's negative sloping, you're going to have a hard time pushing through. This is just a big giant wick above to really flush out a lot of things here. Yeah, I don't know if you guys want to show some other Bitcoin dominance chart here. I think it's pretty interesting, actually. Because if you look at here, it looks like it was kind of finding support here a little bit. It looks like it wants to flush back up here a little bit at the 20-month moving average. But the 20-month moving average is also becoming more flat here. It looks like it's not, it's not as impulsive as it was before. So I'm not sure if it's going to be serving as, good support or not. I'm still leaning towards maybe a little bit more breakdown, especially with big giant wake up above like that. And like Luca was saying, before or during each of these cycles, the top cycle top back in 2017 was December. You have a big giant drop of Bitcoin dominance here. Cycle top for the last cycle was around like November of November of 2021. You have big giant flush down Bitcoin dominance. We haven't really started doing that. I just wanted to illustrate that here in terms of what Luca was talking about. So, all right, back to you guys. Luca, you want to take back over and sharing thoughts on this?
Sure. But before, I would like to talk about the current cycle and how it has developed over the last couple of weeks and and months and years. So what we see here is Bitcoin over the past couple of decades, right? And what we have is essentially this massive parabolic run up in prior cycles, followed by a bear market. And then we once again have the next parabolic move, once again a bear market. Then the next parabolic move and a bear market. Then the next parabolic move and a bear market. But this time was different because instead of having a substantial parabolic move, we had this, this very interesting uptrend over the last couple of years. So as you guys can see here, the majority of the time of this bull market has been spent inside high time frame accumulation ranges, like you guys can see here. And generally, these phases have preceded a large expansion to the upside. Now, I think the main reason behind why we've seen these reaccumulation phases instead of seeing, a blow off top like we've seen in prior cycles and a parabolic move to the upside was because of institutional adoption. So essentially, each time there has been a reaccumulation phase throughout this bull market, it has been marked by a lot of institutional adoption, with people with institutions accumulating, retail getting extremely fearful, and then that was preceded by a large expansion to the upside. And the main point I'm trying to make here is that this cycle has been completely different than prior ones. Throughout this cycle, a lot of people have tried to continuously call for a cycle top and have failed to do so because it has been different from prior cycles. So I think that the best approach going forward is to use prior cycles as a strong correlation, but don't base all your entire thesis on that, because I believe that we're going to see something different than what we've seen before. All cycles have been different from one another in different metrics, different they haven't been the same. That's what I'm trying to say. And this is also the first time Bitcoin actually rallies while the macro has been in a quantitative tightening environment. So we haven't seen a lot of liquidity being injected in the financial system over the last couple of years, yet Bitcoin has went higher alongside with other risk assets. And that's pretty much the first time this is happening in Bitcoin's history. So for this reason, I think that going forward, we should expect something new. And the best way to approach this is to find predictability in unpredictability and assume that things are going to be different. Assume that you're going to be met with the unexpected. And so that's why over the last couple of months, I have been so against leverage. That's why I've been emphasizing the importance of having a diversified portfolio and having some cash allocation, because it allows you to remain flexible in the markets. And it also allows you to adapt yourself quickly to new market circumstances, exactly like we've seen, a couple of days ago on Friday. That was something unexpected, but by having some exposure to cash, I was able to buy. I was able to have limit orders that were filled on that massive wick. And by not having any sort of leverage in my portfolio, I wasn't, completely decimated like those that use leverage were. So yeah, I think that going forward, you should have a more conservative and balanced approach. I think that the latest dump has been a wake up call for a lot of investors and traders. And I believe that going forward, we should maintain a bullish outlook while also remaining somewhat more, conservative and balanced. Now, if we were to look at the Bitcoin dominance, I have here a very interesting chart. So we can see that the Bitcoin dominance essentially had this big deviation above the weekly bull market support band, which has been a really strong reversal point over the last couple of years. As you guys can see here, throughout this bull market, it served as a very strong support point. And because of this deviation is actually very important, because the daily the daily candle has closed below it. And now it seems like the Bitcoin has once again dipped below the 0.618 Fibonacci POI, which has been a strong POI and a strong reversal point over the last couple of months. Initially acted as a resistance back here in November of 2024. Then once again, it acted as a resistance back in January this year. And then it acted as a support later in February and March. So because of this, I think that going forward, the risk reward setup still favors altcoins more than it does for Bitcoin. But as long as the Bitcoin dominance keeps staying below the weekly bull market support band and the 0.618 Fibonacci POI. And considering this, with the fact that we are still entering and moving deeper into the current risk-on environment that will be fueled especially by the overall macro environment, because the Fed will step away from their quantitative tightening measures. And of course, that will lead to a lot of positive narratives that will fuel the euphoria and risk appetite of investors. And I think that that will also lead to the soft landing narrative, which I have covered in the past. I'm not entirely sure whether we'll have a soft landing, but the main point is this. I think that going forward, this is a level by level market and it should be treated as such. We should expect the unexpected. And yeah, I mean, that's pretty much what I'm currently seeing. What do you guys think of the Bitcoin dominance? Matt, do you have a chart you want to share with us?
Yeah, I have the others chart over the total chart. And I just want to point out something that happened recently. Here we go. So just in general, I think it looks like we have bottomed, right? And total really represents all of Bitcoin anyway. So it kind of represents, it's like over 50% of Bitcoin for the total market cap. So I think it's a good view of Bitcoin dominance in itself. And when we look right here at this 382 fib, this is from the 2017 top. and the 2019 bottom right down there. This was COVID right here during that crash, right? Or where was it actually? No, there's like March or April. It's like right here, right? March, April, and then it went lower, right? Others actually went lower than COVID, and actually we just went lower than COVID, and lower than the December 20 low as well. But I think the reason why this flush kind of happened is like, look at like this little fib right here. This wick actually really never back tested at 382. So there was an excuse to get all that liquidity lower. And it just went right through the 236, right to everything. And I think because we're not making a lower low with the body of this candle, I think this is actually looking like more of a bottoming process and a double bottom from back in 2020, which really has only one direction to go now, right? And this others chart represents the altcoins, and it has the direction of up if in fact this is the bottom. So this, in my opinion, is more confluence that the Bitcoin dominance is going to keep falling. And this really looks like a bottoming process to me right now in preparation to just continue the journey higher and higher and higher. So that 382 wick below, in my opinion, super bullish. And I think altcoins are kind of more and more ready to go higher.
Yeah, when I see that the monthly Bollinger Band at the lower side for others get touched, I get very excited about correction being over, because sometimes it almost seems like they want to touch it, they just haven't, and they're just like, just get over it already. They did it, So so this is actually making me very hopeful that I think this is going to end up having expansion, and I think others is going to keep kind of going up from here too. The other thing too that I was not mentioning was we are still above the monthly Ichimoku cloud, and that's not a bearish thing. We back tested everything here again, and we continue to be able to grab liquidity, take out all the stop loss, and deleverage the whole system with this big giant wick, which is why sometimes we have a wick like that through multiple support and held. Like it's go time. I really do think that this is looking pretty decent here too. The other thing I also wanted to show, is with Bitcoin. If you're going back to looking at Bitcoin, I do have a FIP channel here. Basically it was just drawn from a COVID low here to the cycle low that we just had November 2022. You can see how it's been holding these FIP channel levels over here for quite some time. Initially, it was at lower levels. We were able to push up, to get to some of the higher levels, but we're still at the lower FIP levels over here between like 0.136 and 0.382, and been holding the 0.236 here pretty well here over the last few months. And even with that big giant wick down below, we're still holding that level as far as I'm concerned. So that's something that, if you're holding level with a wick down below, this is not a bearish thing. One other thing I want to talk about Bitcoin is this. This is the Ichimoku, and when you're looking at the Ichimoku during a bull market, the blue line holds as support. That is the Ichimoku conversion line, or you can call it, Tenkan-san, whatever you call it. If you're Japanese, I'm not Japanese, obviously, I'm Cantonese. But anyway, if it holds the blue line, the bull market usually resumes. Look at this big giant bull market here from really 2015, 2017, all the way up. It was basically stepping on the blue line, just climbing up here. During this 2000 and 2021 bull market, we really started to have exhaustion whenever we lost that blue line. Until then, we're riding up here in a hurry in 6 months, but we got too exhausted. We broke down underneath of it. We tried to break above of that, but it was on very much of an exhaustive move because we kind of lost it. Next thing you know, we lost it, and that was really a warning sign. Then that was when the bear market comes. What do we have here so far during this market? We've just been basically riding the blue line, to the Tenkan or the conversion line on the way up here, and just stepping. What do we have here so far? We are, depending on your exchange, like some exchange, we didn't touch this, but for exchange like Kraken, we touched that already. So this is not a bearish thing, right? I mean, if you're touching previous support, and it's a bull market support, it's not a bearish thing. I don't know how you'd be able to twist that, because even just looking at how things are, it just looks different from this top, which is why when people are talking about how this is very similar to this, I'm very skeptical that that's the case. And we were holding levels, and I'm going to remain leaning bullish on Bitcoin. And if I think I'm bullish on Bitcoin, I'm even more bullish for altcoins. I guess is what I'm trying to say. I don't know if you guys want to move on to Ethereum. I think we can because it's showing a lot of strength here. And I have this Ethereum chart here that I've shown for for quite some time now. It basically is showing a longer cycle that it has each time from before. And that might just be because the liquidity cycle, the liquidity cycle is also, maybe becoming longer here compared to the past too. But basically, whenever you have a hard time breaking above a resistance level and you have a ascending line over here to serve support, that tells you that there is enough demand to kind of keep pushing price up higher, but you have to eat up all the supply above first, right? You're always going to have a little bit of a deviation here. You have a deviation to the upside here. You have a deviation here to the upside. We had the deviation here back in 2021. And then as we are having increasing demand, there's always going to be a little bit of final flush down, before things go up. Final flush down during COVID here before things go up. Final flush down here, right around April 2025 before we go up. And we have broken above the resistance zone here the second time. I don't think this is a deviation anymore. We're basically doing the same thing over and over again. Now, whether or not the targets up here, hits, it doesn't really matter. I think it really depends on the liquidity that's available in the system and how long it happens. The fact that we just had the flush that we had actually makes me more confident about some potential higher targets, to be honest with you. Some people are calling for lower targets. They're being more conservative. Understandable, because things are going sideways here for so long, and it just demoralized everybody. And it's more conventional wisdom right now that we're not going to go up that high. The conventional wisdom right now is to have conservative targets, is to not be too aggressive. And the whole flush that just happened, they're going to make you feel like you really shouldn't be that aggressive, guys. You really should be more conservative about your targets. The reality is this: you shouldn't over leverage, but you should remain, somewhat cautiously optimistic, because we just have something significant that happened. So I feel actually relatively strongly that I think this move up is probably going to last a little bit longer and maybe a little bit higher than most people would expect. Obviously, it's a level by level market. Obviously, all of this is depending on how much liquidity is available in the system. But that is going to be what I'm leaning more towards now, is to be more optimistic based on what just happened. So, why don't you guys take over?
Yeah, I have here a chart I want to share for Ethereum. So, yeah, I mean, Ethereum right now is looking really bullish. We had this brief deviation below the high time frame support range, which in the past has been a strong resistance. All throughout 2024, it marked local tops. And now we essentially tested the weekly bull market support band. So the last time we tested the weekly bull market support band was back in late June, which preceded this very large expansion. Now we tested it again, and we have managed to reclaim the prior high time frame resistance range, which is a really bullish signal. And on the low time frames, there are a couple of things I'm worried about, like the price currently testing this golden pocket between the 0.5 and 0.618 Fibonacci POIs. So until the price breaks above it, I think that the best approach currently is to remain somewhat more conservative, to avoid leverage, like for the others chart, as I've highlighted. Then it is currently testing the per high time frame support range. Ethereum is testing this golden pocket. So is Bitcoin testing the 2-day bull market support band, as I'll show in just a couple of minutes. But the overall market structure on the high time frames remains really bullish. And I think that as long as the price holds above the weekly bull market support band, as well as this high time frame support range, the most likely outcome going forward is simply a bullish continuation. And once the price will once again break above this golden pocket and test this high time frame resistance range, the best approach will become to remain somewhat more conservative on the low time frames, to be ready for a potential rejection, to be ready for, to hedge against short-term downside risk in case of a rejection. So those are the sort of things I'm currently tracking for Ethereum. And as I've said, purely from a structural perspective, it is looking really bullish. But something that has really caught my attention is the on-chain data, and specifically the Velo data, which I track quite a lot. So here we can look at the open interest and funding rates. As we can see here, while the price is going higher and bouncing hard on the low time frames, the open interest is trending lower, and the funding rates are still in negative territories. So this suggests to me that bulls are absolutely terrified of longing this setup. And, because there are no new perpetual positions that are being added, as we can see reflected in the open interest, and certainly not from longs because the funding rates are still in negative territories. So this only reinforces the idea that the bottom is most likely in, and that going forward, the most likely outcome is a bullish continuation. So, Matt, what are your thoughts on Ethereum right now?
Yeah, Ethereum, it's looking really, really beautiful right now. And I think it looks kind of similar to my Bitcoin chart. I just wanted to show the Bitcoin chart too before I move on to Ethereum. But essentially, I've been tracking this for a long time. I used to show this whole chart for a while during my morning live streams with Tracker, but it broke above this top arc, and it's actually still trying to maintain that right there around 114,400. And when you compare that to Ethereum, we can see that it's the same thing, right? It's really trying to break this top arc, and it actually went all the way back down to the 3553 and just a nice wick down to that range. But this is a beautiful setup, right? It's a beautiful setup that I think we're going to start seeing just this top arc flip to support. All of these previous levels here, you can just essentially just draw a line right here, right? We'll just draw a line right here. That this is a big previous resistance zone, and it's flipping to support. You don't even need any indicators, right? It just looks so beautiful. And yeah, and with that open interest that you've shown, I think it's a beautiful thing. Unless you're James Wen out there who's 50x longing again. I saw that he was doing that today. But yeah, those funding rates just collapsing is kind of what's necessary to reset everything. And I just think it's going higher, right? This is honestly a very bullish look. Previous resistance, flipping to support, and you cannot be bearish on anything like that. And it's ready to go to the 5,000s and above.
I got a couple of charts here to show too. I mean, it's a classic resistance flip support and is holding, even though the wick was extremely scary. But this is the Ethereum dominance chart to tell you the percentage of the crypto market cap that belongs to Ethereum. It basically just pushed through and broke through the Ichimoku cloud here on the weekly, and it's just back testing the top of it. And it looks like it's still kind of holding pretty decent here so far. So there's really not much that I'm worried about Ethereum dominance. I think that most likely you're going to end up having somewhat outperformance of Ethereum still, based on looking at this compared to the overall cryptocurrency market, including Bitcoin. The other thing too, we talked about the others. We're focusing on altcoins, but if you take that out from the consideration, if you don't look at just others, we also look at, let's say, for example, look at Total 3, which is the entire cryptocurrency market cap, excluding just Bitcoin and Ethereum. You can see that it actually looks really bullish here too, where you basically have a big wick right back into a rising 20-month moving average. So, the large cap stuff, yeah, we did have a flush on a lot of things like, Chainlink and, like those kind of larger cap, XRP, like you did end up having a big giant flush, but it just went right into support and was holding, right? If you're also looking at the Total 2 here, which basically you're excluding, Bitcoin and including Ethereum, it did the same thing. It's just holding that beautifully. So it's holding a rising 20-month moving average, and you cannot make this up. Like, it's right there. So I think a lot of these might be more or less, algorithmically driven. On top of that, you also have enough volatility here. Initially, it was squeezing bullish, but now you're starting to have a little bit of expansion here on the cryptocurrency market cap, excluding Bitcoin. So and even if you just look at Ethereum, I don't think I've shown the Ethereum Bollinger Band quite just yet here. Maybe I should show it on a different chart that's a little bit more clean here. Even if you look at Ethereum by itself, it has basically broke through the 0.76 and back tested, like what Matt was saying. And if you're also looking at the Bollinger Band, it's really starting to show some signs of impulsivity here, where the upper Bollinger is going up and the lower Bollinger Band is going down. This usually precedes a pretty big move, kind of like maybe one that we had very similar. This is a perfect illustration in terms of what could happen when you have Bollinger Band expansion, right? So I'm starting to see signs of that. I'm starting to see people like kind of doubting, whether or not this is going to happen. And I think the flush probably already have casted more doubts. But looking at overall cryptocurrency market, looking at Ethereum, it looks more bullish than not. Again, I'm not saying like lower time frame. Lower time frame, I'm and it can just flush. You just saw a perfect illustration in terms of what could happen. Don't over leverage. But in a higher time frame, I'm more bullish than ever still. So anyway, guys, back to y'all. Luca, you want to
Yeah,
take
so I
over?
have here
Go ahead, Luca.
Bitcoin I want to talk about. So essentially, Bitcoin has tested the high time frame support range, aligning with the November to December highs of 2024 resistance range. So I think that purely from a structural perspective, this is a really nice setup. And over the last couple of weeks, I have been discussing the idea that we could have, a deeper pullback inside this high time frame support range. So it didn't happen in the prior weeks because we only had these brief deviations below the support range aligning with the late May highs. So as you guys can see here, we had these two brief deviations below it, followed by quick reversals. And now we had this big pullback that tested the high time frame support range aligning with the November to December highs. So this is a really interesting setup because over the last couple of months, especially since the start of this year, we had numerous liquidity traps that were being set up. First things first, we had the series of untapped lows that were developing on the low time frames all throughout early 2025. So this is a thesis I've covered many times in the past with the series of untapped lows that were developing on the low time frames that all led up to big pullbacks on the low time frames, essentially. And the reason why I think these have happened is because of market makers trying to create for themselves an artificial counterparty. Essentially, how that works is if market makers are trying to buy, they need someone to sell. But if there aren't a lot of people that are willing to sell, well, they can create an artificial counterparty through these liquidity traps. So how this works is essentially we have these series of untapped lows developing on the low time frames where traders set their stop losses. So think about this. You're a trader who wants to take a long position here, where would you set your stop loss? Right at the nearest low, which would be this one. The same thing here. Imagine you want to take a long position here. Where would you set your stop loss? Right at the nearest low. And so there are liquidity pockets that pile up on top of each other. And once there's some sort of news or some sort of event that acts as a trigger, we have this big pullback that flushes of the stop losses. Now, if we think about what a stop loss of a long position is, it is equal to a forced sell order, which is the perfect counterparty for market makers who are trying to accumulate. And so we've seen these series of untapped lows developing all throughout early 2025. They have happened over and over and over again. And they all led to the same thing. They were all triggered by the same thing, which were tariff announcements. So this isn't something new. And after that, we've seen another liquidity trap, but this time to the opposite side, because here market makers were trying to create uh, a counterparty for upside. Essentially, how that worked is they needed fuel for a continuation to the upside. So back from late May to late June, they protected the range highs, as you can see here. So not once did the range highs got swept, because market makers were protecting this time the stop losses of short positions. And eventually we had this big move to the upside that triggered all of those stop losses and all fueled the upside momentum. And here, from mid-July to the present, we had a lot of deviations below the high time frame support range aligning with the late May highs. We had a lot of deviations below the 2-day bull market support band, which has been a really strong uh, reversal point all throughout the couple of past months. So I think the main reason why we're seeing all of these liquidity traps, liquidation cascades, and big swings is because market makers are trying to get everyone out of the market. They are trying to shake out everyone because in these reaccumulation phases, like I have discussed in the beginning of this market talk, they are trying to wreck traders while they accumulate. That's the main purpose of these reaccumulation phases. And as I've said in the beginning, the majority of this bull market has been spent inside high time frame accumulation ranges exactly like this. So this is the main reason why I have been so against leverage, because of these deviations, because of these liquidity traps. They cannot be easily predicted. You cannot easily predict, a liquidity trap like this. You see here a deviation above the high time frame resistance range, another deviation, and yet another deviation back here. Here you would say things are really bullish, and the most likely outcome going forward is a bullish continuation. And then you're met by this very big pullback that completely wrecks you if you're in leverage positions. Exchanges shut up, so you can shut down, so you cannot close your positions, and so you're flushed out of the market. And that's why I think that here the best approach is simply to keep focusing on your spot holdings, focus on the broader market picture and on the high time frame trend, because nothing has fundamentally changed. The high time frame support range aligning with the November to December highs is still holding strong. It has been a very strong bounce zone here. And as long as it holds, I believe that the most likely outcome going forward is simply a bullish continuation. In case it fails to hold, then yes, I would consider taking a more conservative stance on the midterm, on the high time frames, because that would be a structural invalidation. And that would be a clear sign of weakness, which would increase the chances of a potential continuation lower. But as long as this high time frame support range continues to hold, I think there's no reason to panic over short-term volatility unless you're over leveraged or overexposed. So yeah, I mean, that's pretty much what I'm seeing right now. And as for the others chart, as for Ethereum, I think that on the low time frames, the best approach is to remain somewhat more conservative, because the price has dipped below the 2-day bull market support band, which, as I've said, it has been a strong POI. It has dipped below this prior resistance range here. So now it's currently nearing this confluence zone. In case it fails to break above it, then we could see another short-term pullback into this high time frame support range, aligning with the late May highs around $110,000 before a more durable reversal to the upside. But as I've said, I think this is nothing to worry about. This is just short-term volatility. The high time frame picture remains intact, and so the most likely outcome going forward in the next couple of weeks and months still remains a bullish continuation.
Yeah, completely agree with that.
All right. Do you guys have any other thoughts on Bitcoin? Because I also have here the on-chain data for Bitcoin, which is looking very similar to Ethereum. So we have here this chart that should be loading. Okay. Yeah. So another thing I want to cover here is that we're seeing a very similar setup and development to what we're seeing on Ethereum. Essentially, since we had that major drawdown, which flushed a lot of the over-leveraged longs, as reflected in this big uh, wick to the downside, this major candle, it flushed like 40,000 Bitcoins in perpetual positions, which is a lot. And funding rates also dipped deep inside negative territories. Now, another very interesting thing is that with this week to the downside, right, which suggests a lot of buying pressure, especially from market makers and big institutional investors, we had this big spike in spot volume. generally when that happens is it aligns with people and especially big players that are buying, right? And that's essentially how the high time frame support range works. It only works because you have people, especially whales, institutional investors, algorithms, that are all setting up their buy orders there. And that's generally how either a resistance range works because a lot of people are selling there, or how support range works. It all relates to liquidity. And so this is all trackable in the on-chain data. And I think this flush, even though it is the same concept to what we've seen back in 2000 and back in earlier this year, right? With what I covered with the liquidity traps that were developing on the low time frame. So let me go back here to Bitcoin chart so I can show exactly what I'm talking about. Yeah, so as I was covering here, earlier this year, we had these series of untapped lows that were developing. Now, as I've said, the main reason why we've seen these series of untapped lows was because market makers were trying to accumulate. Each time there has been such a pullback on the low time frames, it aligned with a big spike in spot volume. Exactly what we've seen now, because market makers, institutional investors, and whales have bought and have used retail, especially over leveraged investors, as their counterparty. They forced a counterparty because the stop losses or liquidations of long positions are equal to a forced sell order, which is the perfect counterparty for market makers who are trying to accumulate. And this only reinforces the idea that going forward, the most likely outcome is not that we have now entered a bear market, but that the most likely outcome is a bullish continuation.
Oh yes. Are you finished there? Let's
Sometimes
just have dead
silence
air.
silence is the loudest sometimes.
Yeah.
Matt, I feel like you haven't talked to him a whole lot. I mean, like based on looking at this is all very, very promising.
Yeah. It's super promising. And also, if you guys notice the volume that happened over the weekend too, it was minimal compared to previous crashes too. So it wasn't that large after all, which is also a good sign.
Yeah, and also like put out a video um, yesterday too, basically just talking about different financial instruments being potential not scams, but like there are ways to kind of screw retail investor. One of those is stop loss, because a lot of times you can put the level down, and they're going to teach you, hey, protect your capital, put your stop loss in case if things go really bad. But then the problem with that is sometimes you end up selling below your stop loss price because when there's a liquidation cascade, they're just going to sell. And whatever market price is at the time, they might end up just filling that. And you're end up maybe even selling it for a lot lower price than you previously thought. So I always thought that stop loss is actually kind of a little bit disadvantages. I won't say scammy for the little folks, if you will. So.
Well, yeah, anything you put publicly out there, everybody can see it. And if there's enough liquidity there, they're going to go get it. And that's exactly what they did.
Yeah.
There's a
If you
comment I see here. Who will go to jail for this?
No one. That you know that. It's just the way
Baron Trump. No.
the way that the cookie whatever rump or I don't know crumbles or whatever. It's unfortunate because these things happen over and over again. Jamie Dimon is still the CEO and people still want him to run for president. I'm gonna shut up. Okay. But anyway.
Yeah. Let's go down the rabbit hole of conspiracy theories right now.
I mean, exchanges shut down. Nothing worked anymore. I had a lot of hedges set in place, that were eventually closed on a break even because I only had stop losses. At one point, I was up like 300% on some of my hedges. I wanted to close them through a market order, but nothing worked anymore. Only my limit orders got partially filled. And so that what happens. And think about people who were in a leveraged trade who saw the volatility and want to close. they weren't able to close because nothing worked.
Yeah.
Do you
And
think it's by
that's like a
design, or do you think it's by design, or do you think that it's just they're just not able to do it because of they're not set up for it?
I mean, these exchanges worked on clouds that have, a lot of processing power. Like either, Microsoft and Google and all of these data centers are completely trash and shut down at the first, spike in activity, or exchanges are mixed with, market makers. Because exchanges make a lot of money when people are liquidated, by the way.
oh yeah. Oh yeah, they do.
Yeah.
Yeah, with the
Or
exception of FTX, apparently they just didn't know what they were doing. But yeah,
yeah, apparently. Or they were incentivized to shut down by the government. Huh? Conspiracy theory? No.
ooh, ooh, well played.
Yeah.
Yeah.
Incentivized.
Well,
Interesting.
yeah, we do have a little bit of a time here. I think Luca, Matt, you guys might be interested in looking at other like the broader market, maybe looking at the Russell 2000, S&P 500, maybe even potentially look at Tesla if we have time. Let's see what
Yeah.
we got. Yeah.
Do
Matt, do you
want-
have any charts you want to show about the broader market and what your thoughts are on that?
Well, in just a general view without using any TA at all, I just want to show everybody like supply and demand. Really, Bitcoin, previous resistance, flipping to support, right? We can use Ethereum, previous resistance, flipping to support. We can look at XRP, previous resistance, flipping to support. Yeah, and let's look at IWM. What does that look like? Well, it looks like previous resistance trying to flip to support to me too. So I think what we're seeing now is just everything is looking similar. Like so many of the risk on stuff is looking similar. And we can look at Tesla too. Guess what? Previous
It's the same.
resistance. Yeah, previous resistance flipping to support. We can even look at Coinbase here. Previous resistance flipping to support. I mean, you can't really make this stuff up, and you don't even need TA. You can just use supply and demand, and you can just see that essentially things want to go higher. And it's just an excuse to get liquidity lower to get that slingshot pulled back and just released and go higher. But yeah, I mean, I think no matter who's screaming out there, bear market, bear market, bear market, but when you look at it like this, this does not seem or look to me how bear markets start. I don't see that as a possibility because it just doesn't make sense. If a bear market started like this, it would just be weird. It'd be a one-off, and it's not a usual case, and it's just something that you got to stand by the probability, and the probability of everything is things want to go higher. And you can fear all you want, but fear doesn't really make money, really.
But what about those Wyckoff distribution charts that's gonna like keep popping up soon with a slight higher high and exhaustion of the bull market? Oh no,
Yeah. I mean, you can say that all you want, but then that's just putting your own bias into the situation because the data and the history of charts, I think, speaks for itself.
But that's a little bit of like a broadening, right? Like a ascending. No, I don't know. I'm just making stuff up at this point.
But like these are some of the most bullish charts in the market, and they're all risk on, right? Tesla,
Yeah.
one of the most bullish charts in the market right now, and yeah, there's a gap right there. It's a gap fill, and that's kind of where Elon bought his shares recently, right? So if it wants to fill that, fine. Who cares? Still is previous resistance flipping to support. But I mean, I know a lot of people they're screaming at me because like, oh, you said the same thing last time back in February, and it just went right through that previous resistance. Well, that's because it wasn't ready yet, right? But it didn't change the high time frame outcome because we're right back where we were, right? It just needed more liquidity lower again before higher. So
Yeah, I mean, and this is also where the adaptability part comes into play because you have to be flexible in these markets. You have to track, levels by level, assess the broader market picture, see if anything changes. Because a bullish setup can turn into a bearish setup if the prior resistance range fails to hold, right? In that case, you want to have some allocation to cash because that cash allows you to hedge yourself in order to mitigate some of the short-term downside risk, or even set up some buy orders that you can buy once a high time frame support range gets tested, and so forth. So that's the importance of having a diversified portfolio, avoiding leverage, and also to have some allocation to cash, because we're no longer in the part of the cycle where you can just buy anything you want and make profits like we were back in 2022, or like we were back in early April. So the risk reward setup isn't leaning as deep in favor of buyers anymore. So this phase, I think that the best approach is to have some allocation to cash, and depending on your personal risk profile and personal preferences, you should either have a moderately low allocation to cash or a moderately high allocation to cash, right? And after that, you then adapt yourself, and approach the markets level by level, and that way you're not surprised by anything, right? Because you track the setup, you say, okay, now we're testing this high time frame, prior high time frame resistance range. In the past, it acted as a bounce zone here back in late September. It led to this big move to the upside, new all-time highs. Now it's pulling back once again. It might act as a bounce zone. If it fails to hold, however, then you take a more conservative stance, since that could lead to a deeper pullback, inside this high time frame support range, which would be a good buying opportunity if you have the cash on hand to buy with. And so I think the markets should be approached level by level. And instead of focusing, on the short-term noise, on the narratives, or even being stuck in the, high time frame picture, because even though a lot of people tend to say, the high time frame picture is still bullish, and the long term outlook is still bullish. A lot of people say this, especially in top formations. So, and then once they see the volatility to the downside, they find out that I'm not, I don't have as high of a risk tolerance as I thought, right? And so that's how they generally find that out. And after that, a lot of emotional biases tend to occur. So, you know, that's something that you want to avoid. And you can avoid that by approaching the markets level by level, having a high time frame thesis that you stick to, but not that you get blinded with, or that you know, reinforce it to the point where you leave aside key information on the midterm or on the short term that might, contradict or even invalidate your personal beliefs or thesis. But you adapt yourself according to the objective market structure and objective fundamentals. And that, I think, is the best way to approach the markets currently. And the IWM, as Matt was saying, is currently turning the prior high time frame resistance into support. And for the S&P 500, I think that we're currently repeating the same thing that we saw from October of 2024 all the way to February of this year, where the markets were essentially in this bluff top formation, right? And you might take it to December of 2024, rather, where a large rotation towards risk assets occurred. A lot of the liquidity had went into risk assets in particular, and I think that we're currently repeating the same thing, but just on a larger scale. Going forward, I expect risk assets to outperform, mainly because of the overall macroeconomic environment, as that we have discussed in some of our prior collaborations. The small caps have underperformed traditional equities in the S&P 500, mainly because we have been in a quantitative tightening environment. So they aren't primed for growth because of two main fundamental reasons. The first one being the financing, right? So small caps are a very competitive industry, so they need a very high growth in order to attract investors. If they cannot maintain that high growth, because quantitative tightening did allow them because of high interest rates, they then need to appeal to another source of financing, and the second one is through equity, right? So they issue equity, they dilute their shares, which, even though it leads to better fundamentals, it affects the stock's price directly, because the growth of operations and fundamentals is uh, funded directly by investors. And now we don't have that issue anymore. So I believe that small caps might be perceived as a as a better investment than what they have used to be over the last couple of years, which is why I believe that small caps are likely to outperform the traditional equities in the S&P 500 in the next couple of weeks and months. So what do you guys think on this correlation between small caps and the traditional equities?
I mean, I think the truth is the small caps really haven't done anything for about 4 years, and it's just been forming a big giant cup. Just like what you're showing, and it does actually went back down in April and even flush out leverage, kind of like what we kind of just did with crypto. And that become very, very bullish, even if it goes down to that zone that you're showing, which I think is entirely possible. I like it's just so much accumulation for such a long time that it's time for it to shine. And I think whenever Russell 2000 or IWM ends up doing very well, I think a lot of people are going to end up getting caught off guard in terms of how bullish things could be, because that's really the euphoric phase that could come if IWM just keeps making all-time high. That's basically what we've seen from previous cycles, and I don't think the cycle will be any different from that perspective. Nats, any thoughts on that?
I mean, other than everything, all the risk on stuff is flipping previous resistance to support. Not really. I mean, I just think that this is setting up to be something super bullish that people are just not very bullish on yet, because they don't like to buy before breakouts and they don't like to be bullish before breakouts, but they like to chase later.
Speaking of which, I can show this one thing here that I posted on X. And I do, before I show that, I do have to apologize because I show this before the Friday crash, obviously. So whenever you show your portfolio, and I purposely, I don't really like to show my monetary gains because I don't think it's really that relevant. But I just wanted to show you in terms of, market psychology. And even though, I was bullish at a certain point, what I ended up doing was, there's a rationale behind it. First of all, I don't own any TSLL. It's an extremely volatile stock. I think if I was going to own something like double leverage, I probably would not like to do that for Tesla just because of my own risk appetite. I did end up trading Tesla during this previous bull run over here a little bit. I didn't really know what I was doing. I actually didn't really do much technical analysis until maybe starting around like 2022. I really started getting a lot heavier on technical analysis, 2023 and so on and so forth. But the whole idea is this. I set up a goal, even if I didn't do any technical analysis. I started a position here whenever things start dropping again. I didn't know what I was doing at the time. It just formed a little bit of a lower high here. You should be cautious, but I ended up started like a really, really tiny position here. When it dipped down, I started buying around 200. And when it dipped down a lot lower, this is really when I was starting to see like that was the maximum opportunity here. So I ended up buying a lot more, really starting my position right around whenever it was like around the 100s or so. And then since then, I've been buying the dip over here. And whenever it gets up higher, I was very bullish here, but I did not buy it because the risk is elevated. There's a very different thing about, being, you cannot help it to be an emotional being, right? You have to be optimistic, and it's okay to be bullish, but the risk is high here. So I did not buy when it came down here to the dip. In the dip here, I ended up buying. And then when it just kept on making, lower highs and lower lows, I was a little bit more cautious here. And I was looking for more opportunities lower to buy. And I was setting myself a goal, hey, if it dips down below 200, that would be when I buy. And so I bought this whole trough over here. And whenever it makes a high again, I just decided, hey, you know what? It's making higher highs, higher lows here again. Keep buying, right? And whenever it just like shot all the way up to about 400 again, everybody starts to be euphoric. And I was euphoric too, because there is a chance for it to potentially break above and go a lot higher. And if you end up selling here, you have to be right twice. You have to sell here, and then you have to figure out when to buy back again. This is a high, low type situation. There's a potential for it to break out here. There's no guarantee that it was going to break out here, but I decided not to sell. So I ended up what you call round tripping downwards, right? because I made a conscious decision to not buy here, but also made a conscious decision to not sell, with the understanding that I could be wrong, it could go down again, and when it goes down, you have to have a plan. What is your plan? Are you going to buy at 300, 350, 300, 200? Like, where are you going to do? So I just end up dollar cost averaging down this drop over here and just adding a little bit more to my position because the market gave me an opportunity to buy, and I'm going to take it. And that's exactly what I ended up doing. Now, ever since then, like, do you see me buying Tesla? No, like it's bullish, but I'm not chasing because I already suffered through all this emotional work down here. So I'm just gonna be sitting here looking for a potential breakout. That's what I'm gonna do.
Smart choice.
Yeah, I mean, a lot of people saying, "Oh, but you guys are so bullish up here." Yeah, but I wasn't buying TSLL. I wasn't doing like 2x leverage. I was just holding. Like the worst case that happens, it came back down and formed a higher low, and I don't know how low that higher low is going to be. Nobody really knows that, right? But then you have to have a plan. You have to figure out what you want to do. And next thing you know, it's worked out pretty well for me.
Yeah, and you built an even bigger position than before. Instead of just selling and trying to time the last top, you have even more shares now for this time around. So it's a better situation.
Yeah, I think this actually puts me into a lot better emotional health compared to when people get really euphoric and start to buy here. Like that's not the way to do it. I think you have to have a plan, and it's a level by level market. Even if I start feeling euphoric and things could break out, like you have to be able to control yourself in terms of what you actually do. But anyway, those are my
Yeah.
thoughts.
And doing it this way too is like a lot of people, they regret selling too soon. And doing it this way, you don't have to have that regret because you can just keep accumulating until there is a breakout. And then once it does break out, you're like, okay, yeah, I don't have to worry about selling now and just enjoy the ride. And so many people did that with the Palantir and they regret it. And if they did it this strategy, they would not ever regretted it at all.
Yeah. Luca, do you have any thoughts on this?
Yeah, I also have a couple of thoughts on Tesla I want to share here. So, yeah, essentially the price has failed, unfortunately, to hold the prior high time frame resistance range here, which has been a strong reversal point back in mid-January of this year. And it seems like we had this brief deviation above it, and now the price is once again has dipped below it. It also aligns with a 0.786 Fibonacci POI, making it an important range to say the least. And it is pretty much the final line in the sand, in my opinion, that stays between us and new all-time highs for Tesla. And now, going forward on the low time frames, we might see a test of the 2-day bull market support band, which, as you guys can see here, it has been a pretty strong reversal point over the last couple of months. And so this range also aligns with a 0.618 Fibonacci POI, making it a strong support range. I think we could see a deeper pullback like this in the next couple of days before a more durable reversal to the upside. And once again, this is just short-term noise. This is just short-term volatility, nothing really to worry about on the high time frames. Tesla remains my second highest conviction play after Bitcoin, and it is the second most largest position I have in my equity portfolio after IBIT, because I have a lot of conviction in Tesla. I love what Elon is doing. I think that the fundamentals are improving and the macroeconomic environment will only act as a very strong tailwind for Tesla's overall business model. And as the markets will price Tesla in more like a tech company rather than just a car maker, I also think that will lead to higher prices in the next couple of weeks and months. And if we remember what happened back in November and December of 2024, Tesla didn't really perform like the other traditional equities in the S&P 500. It mainly performed as a risk assets, as a risk asset. And I think that going forward, it is very likely we're gonna see something very similar to that, meaning that while the traditional equities in the S&P 500 and the S&P will be within this high time frame distribution range as liquidity starts flowing into risk assets, I think Tesla will have a strong tailwind off of that. So yeah, I mean, there is also this unfilled gap here around $395, which also aligns with a 2-day bull market support band. So we could see a test of that range before a continuation to the upside. In my view, it could also be a good long opportunity for those that have missed out. Personally, I have made most of my gains back in March and April of this year. Not to say my accumulation process all throughout, 2023 and 2024. But here I have made my final big buys, and from then on, I just, held my position because I'm letting my thesis play out, my long term strategy, and my overall long term plan play out. The hardest part of investing is not knowing when to buy or when to sell. The hardest part is what is in between, because in between you just have to hold. You just have to then adapt in case something fundamentally changes, and that's the hardest part of investing. It is not about the beginning and the end. It is about what's in the middle. That's the hardest part, and not a lot of people have the patience to let their own thesis play out, which I think is a mistake. And the main reason why a lot of people don't have the patience to do it is mainly because they are either caught in the short term noise, they are either affected by emotional biases because they haven't aligned their strategy with their personal preferences, and they find out at some point that the portfolio they have is too volatile for them, and so that's a big mistake, or they're over leveraged and some short-term pullback catches them off guard, and that's another big mistake they do. And so yeah, I mean, that's pretty much what you have to pay attention to when investing, not when to buy or when to sell, but knowing for how long to hold, and just having the patience for your own thesis to play out. And so going forward, in my view, there's no point in trying to buy leveraged funds because Tesla itself will perform really well. And the same thing applies for treasuries. You know, a lot of there have been a lot of treasuries on Ethereum and Bitcoin and other altcoins that have been you know been launched. I think that the best approach is simply to keep focusing on the underlying asset, not to buy something that has a really high beta compared to the underlying asset, which is already really volatile when compared to other defensive sectors. And you can make a lot of gains simply by holding spot holdings uh, in an underlying asset, simply by holding spot shares or spot Bitcoin. You can make a lot of money off of that. You don't need the non-systemic risk of leverage. I think that's a big mistake, and I have always stood by that because I have been there. I have lost a lot of money using leverage in my first years while being in the markets. And at some point, I found out that, you know, long-term holding saves you a lot of, emotional stress and simply outperforms. Very few traders actually durably outperform the markets on the long run. And investors who simply have a strategy that they stick to and then they make incremental adjustments as the markets develops. So that's in my view the best approach you can have of the markets. So yeah, I mean, what do you guys think on that? I would like us to talk about a bit of leverage and
Yeah, I
things
think
like that.
leverage. I think leverage is fine. I still play around with like perpetuals and crypto, and I had an XRP one that I had for a while, and my liquidation I think was like under $2. I'm like, it's never gonna get hit, and then boom, it got liquidated. But it was only, I mean, it's money I'm willing to lose anyways, so I just do it for fun. So if you have that mentality, like, yeah, it's just okay, I'll play around with it, see what happens, just for funsies, that's completely acceptable. But for some of these posts that I've seen on X where their whole life savings is in like a perpetual or whatever, like that is just super risky. And you got to understand, like, you have no control when something like that happens. When you have a liquidation level that you see and then you can't even access your account to even add to your funds or whatever to avoid that liquidation, you're risking your whole net worth on one crypto exchange allowing you to do something. So I think it's super risky, but for playing around with it, it's fine, right? I do it all the time, and I'll still do it for the future. But I'm not going to put a lot of huge percent into it. I'm going to do it for fun, just to see if I can like play around and maybe grow something that's small into something larger, just to make things more exciting. That's my view on it.
And I think, Matt, you also have learned through the hard way, like a decade or so ago, about the same thing that Luca was talking about in terms of long-term, investment, trying to reduce emotional stress. Because, like, you've also gone through the whole journey as well, right?
Oh, absolutely.
Because I think a lot of the stories that we have, like all three of us, actually are pretty much in agreement with that strategy, and it's been playing out well. But a lot of people, like, if you don't know what you're doing, it's just like driving a car. Like, if you don't know where you're going, you're gonna get into accidents. That's usually the majority of the time when accidents happens, because like you're changing lane and you don't even know like where you're going. You try to figure out things at the same time, and you get flustered and you make a poor judgment, and that's when accidents happen, right? Like if you have a strategy, if you know where you're going, for the most part, you should be fine. Even though you're going to take some wrong turns here and there, you're going to get things on your car here and there, and there might be some other things that might happen, and you might get into an accident. It might not be your fault, but you really truly minimize the amount of accidents and unexpected things that you would do. And that's what kind of technical analysis is to me. And that's also kind of how looking at the whole overall market is kind of to me. It's really about just having a plan. You don't have to be right all the time. You just have to be more right than you're wrong. That's kind of how I approach things. With that said, I see no reason for me to really do any leverage. I do have a T triple Q position, by the way, like from a few years ago. I never really sold that. And it's been in pretty decent unrealized profit right now, even with the whole like April scare. I do have a double leverage coin position, which again, it's still in pretty decent profits right now. But that's also money that I'm willing to lose. I just want to dial up my leverage a little bit, and if I end up underperforming because of that, I learn something from it. I don't have to be right all the time.
That's a little bit different than those kind of levers. Is actually safer than perpetuals on crypto exchanges, because you have 100% chance of liquidation in those. And with yours, you don't really have 100% chance of liquidation, because they're not going to go to zero.
Yeah, well, I mean, they can get close to zero, but like if they chop around for 2 years, and they're going to drop like 70% or something like that. But I think it's just one of those things. Like if you're seeing something more bullish, IWM is going to break out. If you really want to dial up the leverage, understand that you could lose your pants if it ends up just chopping sideways for a long time. But at least I won't lose everything. And even then, I choose consciously not to do double leverage Tesla TSL just because of like the crazy volatility that it presents. But
I do it still. I do.
Yeah, no, I bet you're in profits, dude.
I was dollar cost averaging all the way down from like that April crash, and I got it. I think I got my cost under like $16 or $15 or something.
That's amazing.
Yeah, finally, yeah.
Yeah, and I think it's okay to figure out what your risk tolerance is, but just like when you're driving, like if you're wanting to I don't know, like take like a different road that might be a little bit more risky but more scenic, you do it, and you know what the risk that you're taking. And if you end up getting a flat tire because you run into some rocks, then hey, so be it. Do you have a spare tire? You do? Okay, great. Like never do anything that you're going to use for rent money or mortgage money, or like money that you need to pay for hospital bills and stuff like that. I see people doing it all the time, and it's one of those things that, like, okay, so you are doing this because you want to make money because you don't have money, and you are thinking that you have to do this because you don't have money or else you won't catch up to other people. But the reality is that market makers, like, they know exactly the tools that to offer you to give you low probabilities of winning, and they don't care how poor you are. They're just going to take away your money. They want to prey on you, and they want to give you these false promises of potential gains when in reality you have low probability, low chances of winning. So yeah, stick with good assets, stick with the market. But yep.
I mean, the way I see it is with leverage is that it has been a culture promoted by, a lot of influencers to promote, like single groups and to promote, to shill a message or to have a narrative that they can grow their audience on. And there has really been this culture of getting rich quick with leverage or options through investing. You see on X or on TikTok, a lot of people making supposedly making millions of money of dollars with leverage or with an option. And then, you know, they promote this thing that if you don't get rich quick, you're not going to make it. But that is very far from the reality. And I think that promoting the right message is very important because, you know, investing is a long run. It is not something you do a couple of months and then you just quit it. It is something you do, your entire life. And so when you have that mentality, you know that you're going to do this your entire life. Well, you avoid doing stupid things on the short term, you know, and that's the way I see it. So let's take an example in life, for example. You have your whole life ahead of you, so you avoid, taking drugs and overdosing, doing something stupid on the short term because you want to live the rest of it. And same goes with leverage. You avoid doing something really stupid on the short term so that you can live on and you can compound your gains. So I think that the most important thing is investing is to realize that you make gains and then they compound. That's the whole point of investing. Now, the way they compound is simply by having the patience of investing over a long period of time and by avoiding substantial losses. That's my main focus. My main focus is not necessarily on making substantial gains, but on how I can avoid substantial losses. So, because I avoid substantial losses, of course, I'm going to make profits, and those profits are going to compound. But you only start finding out ways on how you can avoid substantial losses once you change your whole mentality from how I can make more profits to how I can avoid substantial losses. Because a lot of people think, well, how can I make the most out of this? How can I make the most gains right now? So they start investing in these really, really volatile things like treasuries, like, using 50x leverage on altcoins, which are already extremely volatile. And, they have substantial losses. But by thinking on how you can avoid substantial losses, you not only avoid substantial losses, but in the same time, you also let your profits compound over time. Because if you have, a bad month that sets you back 2 3 years in terms of performance, your profits are never going to compound. And that's the whole point of investing, is having your profits to compound and having money working for you. And that's also the problem I see with day trading, because a lot of people lose a lot of time day trading and eventually they don't outperform the markets. The whole point of investing is above money is getting more time to do things that help other people or to do things that, you know, make you happy or to do things with your family. That's the whole point of investing. It gives you more time, but trading doesn't. And so I think that above all, the most important thing here with us and with influencers in particular is to spread the right message. So that's how I view things.
Yeah, no, I more or less completely agree. I think we're getting close to time. Matt, you want to scroll over to my screen here? I just want to share something that I posted many months ago. The whole purpose is not to not drive. You have to go. You have destinations. You have places you need to go to. You just have to make sure that the car is well maintained and that you do everything you can. And if you understand what the risk is, just like, and I'm sorry, I have to do this. Just like, you have to have sex. Like, it's a part. Well, you don't have to, not necessarily. You can be asexual, and it's completely fine. But for a lot of people, they do need to do that. It's something that is acceptable. You do it. You do it with the right people, with someone intelligent. That's someone that's also respectable. If the condom breaks, if you get pregnant, you can decide whether or not to keep the baby or not. If you have good genes, you're probably going to be okay. I bought Tesla. I don't know exactly whether or not what it's going to do is a level by level market, right? If the support broke, well, what are you going to do? You decide to keep your shares, you buy more, right? It's a good tech. It's a bull market. You're probably going to be all right. So the way I see it is you don't have to be perfect all the time. You just have to do it, figure out what your risk tolerance is, have a plan. Don't do anything that you wouldn't do. Don't do anything that you wouldn't do with somebody that you don't respect. That is, somebody that you don't want to, end up having any potential accidents with. And if you have a high probability of failing, like, don't do those kinds of things. That's kind of my message as well. So
I will 100% steal this.
I posted this, like, this is March when Tesla was going down a lot,
Yeah.
and people were scared, and a lot of people are very, very bitter. And the message is not that you don't have to get it all right. It's okay to get things wrong. What are you going to do about it, right? And what are you going to learn from it? That to me, I think that's more important than what actually happens.
And I think what a lot of people don't understand too is, like, when I post a level or something and then intraday it breaks and they're like, "Oh, it broke. You're wrong." I'm like, "Well, you don't give it enough time, right? It's fine. They're called liquidity grabs for a reason, and just let it play out, right?" And we see that all the time, especially with high frequency trading. You're going to see liquidity grabs up and down all the time, and you just got to let things play out. And just because some level breaks temporarily, it doesn't mean it's game over. You just got to let it follow through. And the way things are shaping up, I think we just need to have more patience. And all of these liquidations that we're seeing is going to be, in my opinion, super bullish for the long term. And I think it is likely we're going to have at least another year, maybe year and a half, maybe 2 years, maybe, who knows? Maybe it's going to be 2029, exactly 100-year anniversary before we have the meltdown. Who knows?
But the Roaring 20s, right? The great
The Roaring
Mattsby
20s. That's
and the
why I'm the
Roaring
great
20s.
Mattsby.
Yeah.
Yeah, and I think that's why Luca and I get along so great. I'm the great Mattsby from the 20s, and he's about, his profile even shares about that, the Roaring 20s.
And now we're turning Luca around about the market potentially lasting for longer.
Yep.
Yeah. Well, we didn't do that. The market did that.
Yeah, the market did that. Yeah.
The dark side.
Exactly.
Yeah, no, always enjoy having these collaborations with you guys. I think we can do that maybe like twice a month or something like that. We'll just keep it going.
Exactly.
Yeah, sounds good. Always enjoyed them having with you, and I think that pretty much wraps up our market talk for today.
Yep.
Yeah, let's do it again. All right, guys, take care. Have a good rest of the weekend.
Right, let's end on a high note. Thank you guys for joining, and I'll see you guys in the next one.
Take care. Bye.